Welcome to the Financial Advisor Workshop podcast. I'm your host, Brian Kasal. Today, I wanted to discuss exactly what I'm seeing in the financial advisory industry, help you protect your firm and best prepare your firm for growth. I'll be answering some questions prepared by my team based on the type of content we've been releasing that's gotten the most engagement over the last couple of months. So question number one, what are you seeing out there in the market and all FAs need to be aware of? So we're seeing out there a lot of changes. Some are slow, some are swift. But the changes that are key is we're still in a weak market. We did have an interim bottom in October, but it may not be the bottom that holds. And so when we look at the internals in the market, the stock market, we're seeing weakness across the board, things that are typical in a bear market. And so advisors need to be aware of the fact that it probably hasn't bottomed. There's a lot of layoffs going on or a lot of other pain, but at the same time, there are some positive things going on in the economy that could maybe keep the recession from being as severe. It's like we have different we're calling it rolling recessions, where we had a complete meltdown in the hotel industry during the pandemic that led to that huge 32% decline in GDP in the third quarter of 2020. And then the recovery in the fourth quarter. But now we're seeing a big hotel and travel boom that is a counter boom to what are their layoffs in other areas. So we're seeing, like you say, rolling layoffs or rolling recessions in a sense. So that's a very strangeness that we need to figure out how to handle. So the best way to discuss the current state of the market with clients is discounting all of the confusion that's been created by the war in Ukraine, and then also by the seizing of the oil markets. There clearly has been a disruption in supply in the oil markets. Much of that had to do with a government policy where we stopped the Keystone Pipeline, we changed drilling capability on federal land, and we're trying to restrict and hamstring the oil companies. And it's based on the idea of fossil fuels being more dirty and electric vehicles being better. And many people are happy about that. At the same time, there's a concern that maybe they've gone too fast. And that's what the market's reacting to, because it was such a severe change. And that's why the market's been very, very difficult. So the current state of the market is still reacting to all that and discounting all of that. And depending on how bad the earnings recession gets, which will be in the first quarter to be announced in April, then we'll see what the market starts to do with declining in earnings. How to put clients' minds at ease during times of uncertainty is a big topic. And the way to answer that basically is we are in a position of where we have to be very, very defensive for clients. When we get involved in a market like this, clients can lose 30 to 50% of the money they made in the entire decade, the last decade. And it's important to be very, very careful what you do. If you're holding more cash, great. If you have a model of rotation to get out of the market, that would be smart, and not take a lot of risk here. Because the more risk you take, you could get hurt very badly. Many of our clients are older, they're retired, they don't have time to make the money back. It's important to protect them. So if you haven't protected them, it's hard to put their mind at ease. If you have protected them, you can't. So how often should you directly contact your client is a good question. And that one, we usually do reviews every 6 months, but we're in a position now where we probably need to communicate with them more often. Certainly this whole bank concern, many people think that their investment accounts are just like a bank because it's all money, and they don't really think of the distinctions between this regulator and that regulator. So if you have money in money markets, they're not bank deposits, you're safe. It used to be the bank deposits were safe and everybody was worried about money markets. Now it's the opposite. There were 2 money markets that broke the buck in 2008 when things were really bad, but yet they saved the world by creating bank deposits and bank guarantees. Well, now the bank guarantees are struggling because some of the banks are failing because of mistakes made primarily at Silicon Valley Bank and a cascading effect of impression to other banks. So that I would, because of that situation, I would certainly make sure you contact your top clients during a time like this. They shouldn't be concerned. And if there was a real reason to be concerned, you should talk to them anyway. But it wouldn't be a bad practice to call some of your top clients and confirm with them that they are okay. Great. How to create a newsletter or podcast that your clients can listen to uh, will act like you're calling all your clients directly. That's true, and that's what we've done, just like this program we're doing right now. And many of my clients say, "Well, we don't really need to talk that often because I do listen to your podcast, and I feel like you're talking to me directly," which I am. But by doing it that way, you can talk to hundreds of people directly, and it maybe minimizes the number of calls you need to make to explain things. But as far as like your normal role as an advisor, you definitely still need to keep in touch, but maybe a little bit less often because of that. And now a little bit more often in recent times because of the bank crisis. So it just gives you a little bit more leverage to communicate with a lot more people, which is really great. Any exciting and interesting ways to find new clients? Well, if you did do the protection, you'll probably get a complete uh, push towards you. We've had that happen at Fourstar. We've had many clients did relatively well in the market decline, down single digit, down 4%, down 7% in some of the portfolios, not down 19, 20, 33, 44, Tesla down 69 and 75 at one point. So we didn't have those bad experiences. So an interesting way to do that is actually just do better in a bad market. And we did that. Another thing is just to communicate more with them, because if you communicate more with them, maybe their advisor's not communicating with them. So this is the time to look relatively better and smarter than them and talk to them about how you are protecting clients. And we are worried about their family, and maybe you can help their family. Be a good way to get introductions. How to explain the Silicon Valley Bank collapse to clients and what this collapse means to the market. Well, Silicon Valley Bank was a real unique situation because all banks are fractional reserve banks. So you put in $100,000 in a bank and they lend out $1 million. So that $1 million isn't there, and the 100,000 isn't there either, because they only reserve about 5% of what they put in. So you put in 100,000, they leave 5,000 in there, and they lend the rest, but they lend 10 times that number. So that's a normal situation for a bank. But what Silicon Valley Bank did is that they lent a lot of money, obviously, but then they also had a lot of money in bonds that lost value, and they have a concept called mark to market, and they mark to market, and it really wasn't the right thing for them to do. And they sold the bonds and realized the loss, which upset their capital. So it was really a case of bad management. All banks operate on fractional reserve, and if they hadn't sold those bonds, they wouldn't have destroyed their capital. They must have thought they could raise money quickly to bring their capital back up, but it didn't happen. They only had 48 hours. Everybody pulled their money out. And the other reason why Silicon Valley Bank was important now is just to give a sense that there is a much quicker reaction to things like this. Plus, the markets are more efficient. So in the old days, back in the 1930s, It's a Wonderful Life, when there were bank runs back in the 1930s, you couldn't just go online and pull your money out. You had to go to the bank, or you had to write a check, or you had to do something that took a lot longer. So bank runs took a lot longer. Now they'll take 24 hours and the whole bank is gone. So that's really a kind of unique situation why they need to watch things much, much more closely. So Silicon Valley Bank was an isolated incident, I believe. There are other banks that are experiencing some difficulty because of mistakes they made that have come to light. But most of this is minimizing, and most of the runs on the banks are minimizing right now. So I think we'll be over with this soon. We also get the question of important issues that are relevant to client demographics. So with ChatGPT and now the Google sponsored program as well could provide a lot of information automatically and react more quickly to requests. I would say, though, there is a lot of human interaction that's still required and judgment that even ChatGPT can't come up with. So it may may give you information quicker, it may react to certain things quicker, but I don't think it's going to replace advisors because you really need someone with judgment. And Chat GPT isn't necessarily judgment, but it certainly is reaction and information. So you could compile information a lot quicker, customized to what you want by using Chat GPT. There's a new tool being offered for independent advisors right now only, but it could be coming to a brokerage firm near you. It's a program called Eyeballs. And basically, it's a data response system on your phone that you can ask questions of your accounts. What's the value of my accounts? How many shares of IBM do I have? Ask all kinds of different detailed information about your accounts. You can also show on your phone the reports that you would get normally in the mail, and maybe any other research on stocks or research on your accounts that's tied to your accounts. So that program is available with any firm that uses the aggregator Orion. Orion is the first firm to use it, and Fourstar, my firm here, our firm, is the first firm in America to have Eyeballs. So Eyeballs is an emerging skill that is the tool that's going to be able to be used by people all across the country. The financial industry was a little slower to adopt phone apps, but this is the first phone app of its kind. So now we're finally coming in line with much of the world that we're able to access most of our investment accounts through our phone, which is quite interesting. But we won't for a while. You usually don't know the market's bottom until you have a series of testings that go through. So a market will rally and then start to pull back again, and it breaks the previous lows. Then that wasn't the low and it's going lower. So the market will test the bottom and then hold. It won't go as low as the previous bottom, rally, and then test the previous low. And then we start getting a succession of higher highs and higher lows. That's when you know there's likelihood that there's a bottom. That will take maybe months to develop. So let's say the market would have bottomed later this summer. We may not know till the fall that that was a real bottom. So that's why an investor who is trying to find the bottom will never find the exact bottom until long after it's done. But there is a way you can kind of look at evidence going along the way and start to push little bits of money in the market to possibly take risk. So take advantage of it if that was the bottom, but not put all your money at risk. So we have a model that does that at my firm, Fourstar, where we start in quarter increments, where we'll put some money in once we see a bottom has been reached and it's retested, and then we'll put some money in. And then we see another higher and higher low, we'll do it again. And then we gradually get back in. That we take advantage of some of those low points. If anybody ever actually catches the exact bottom on that day, that's probably luck. If you are really not price sensitive and you're okay with letting your portfolio go down a little bit, I wouldn't be, but if you're okay with riding it out, there's never been such a thing as a perpetual bear market. And no matter what, eventually it will bottom and the market will discount all the pain that's out there. And then it'll start going up long before anything is solved. Because the market will anticipate the recovery, anticipate the solve to the economy, that the economy will get better. But then the market had already bottomed 6 months prior to getting any real news that that's true. Market will anticipate it. So the market is a discounting mechanism that will often discount what they believe to be possibly good news 6 months before it happens. So you'll see on the screen a chart that shows the historical Treasury and S&P 500 returns. And there's 4 different quadrants. This chart shows positive stock market, S&P 500, on the bottom axis, and on the left axis, the returns of the Treasury bond market. And so every dot that's on that graph represents a year. So you touch a dot and you go down to the bottom line, and it says the top line there said bond market was up, was that 20%, 27%, and the stock market was up 20% in 1 year. So every dot corresponds to a return for the stock market and the bond market. So you'll see in the upper right, that is where the stock market's positive and the bond market's positive. So the normal state of being is where the markets are generally positive. People earn interest on their money in the bond market, and then they preserve the value in bond market. There's usually not much volatility. And then the stock market usually rises 85% of the time. Stock market is going up. So that's what we see in the upper right. Years when the stock market is up a little bit and the bond market is up a little bit. Sometimes it's up a lot. But those are the measurements. So then if you go to the upper left would show stock market down, but bond market up. So usually when the stock market is down, there's a flight to quality, and people think bonds are more stable. Obviously, they have been historically. So they'll move money into bonds. So when you go all the way out to the end here, there's one dot way out here. Anybody who is watching the numbers can probably guess that's 2008, where the stock market was down 37%. But if you see, the bond market was up just shy of 15%. So if people were in a blended stock and bond portfolio, they were not down 37. They were down maybe in the 20s or high teens. And that was a way to minimize the damage, because the bond market went up even though the stock market went down. In the lower right, here's where the stock market is up, but the bond market is down. But you see there's 5 dots in this box, and every one of the dots is less than 5%. So the bond market, bear market, is usually pretty minimal. Bonds are very stable. You're down less than 5%. This could be interest rates rising, then the bond value drops, and so, but it's a small number usually. So then in the lower left is a box that had never had a dot in it before until the year of 2022. So 2022 was the first year that both the stock market was down almost 20% and the bond market was down about 12%. That has never happened before in the modern market history, in the modern markets in America or overseas. So why did this happen? Well, it happened because interest rates were rising. We started from a base of 0 interest rates. Even those old timers that might remember the 1970s, when in the 70s also rates were spiking upward. We did, however, start from a much higher level of interest. So bonds are paying 8 or 10%, but then they went to 15 to 20%. Anyone who was around then might have had a 20% money market and savings and loans. They might have had a 16% car loan that people thought that was normal back then. I was alive then myself. And but what did buffer the decline was the fact that there was a higher level of cash flow in the bonds. So if the bonds went down 10%, maybe there was 10%. Some of those years might be embodied by these dots, where the bond market was down a little bit, but the buffer was the cash flow coming out of the bonds. This time we started this decline where there was no cash flow, 0, maybe 1%. Money markets paid 0. That's where the Fed policy has been for a long time. So all we got was decline in the bond value. And that's why last year I called the worst investing year of my 39-year career, because more investors got hurt in the investing markets last year than even a year like these years back here, because there's 10 times more money in the bond market than there is in the stock market. So people who put money in safe vehicles, expecting it to stay safe, were not rewarded last year at all by being in the bond market. So they got hurt pretty badly. And that's also why the banks are in a little bit of trouble, because the banks bought a lot of bonds, thinking they were safe and thinking they were stable, not calculating what could happen if rates spiked up dramatically. And that's exactly what happened. So that's why 2022 was the worst investing year, certainly of my 39-year career. And I'd say probably the worst investing year in America, because more people got hurt worse last year than even these bad stock market years over here. So it's important to understand these concepts and realize the world isn't over. All this will recover from the short run. These are the things that have happened to us. Well, that's it. That's all we have for you today, everybody. Thanks for being with us today on the Fourstar Financial Advisors Workshop. Keep growing out there, everybody, and let us know if we can be of help.